Hello and welcome back. In the last lesson, we talked about the role of financial institutions in helping you reach your financial goals. Now, we're going to talk about investing. Hopefully you remember talking about investing when we discussed the different types of income. If not, no worries. We'll do a quick review here. Investing is a catch-all term for the process of buying assets with the expectation that they'll either A, increase in value over time, or B, pay you returns in the here and now, or both. Earlier in this course, we differentiated between investment income and income from real estate. That is because these two different sources are taxed differently and generally operate differently as well. But for the purposes of this lesson, we'll be including real estate as a form of investment opportunity because, as you'll see, it really fits the bill. Before we get to all that, however, remember that the first step to investing is saving the money you need for your initial investment. Only once you have enough savings can you really dive into investing. There are a lot of different investment opportunities out there. The first and most basic is something that Flush has had since he was a kid, a savings account. As we've discussed in previous lessons, a savings account is a great place to keep your emergency fund because it pays you a little bit of interest and keeps the money safe for you. But the interest on a savings account is so low that it is rarely considered a good vehicle for generating investment income. One of the next most common investments is real estate. This can be buying your own home, buying land, buying rental properties and becoming a landlord, or buying commercial property for businesses to rent. You can also look at things like stocks, bonds, mutual funds, annuities, commodities, and cryptocurrencies. All of these different investment options come with different levels of risk. Usually, the investments with the highest potential for return also come with the highest risk of loss. There are a lot of reasons why this is the case, but the important thing is just to remember that it is. The level of risk you take should match up with your own emotional and psychological tolerance for that risk and the goals you have for your investments. Some people take a lot of risks and others prefer to play it safe. Flush is comfortable with a medium amount of risk. For that reason, he keeps an emergency fund in his savings account but has never put money into a bond, mutual fund, or annuity. A bond is essentially a loan that you are giving a business or government that they agree to pay back over a certain period of time with a certain amount of interest. Bonds can be risky, but usually they're not because governments and corporations receive grades from various private organizations on how likely they are to be able to pay that bond back. A mutual fund is quite different. The best way to think of a mutual fund is as an investment portfolio that has been pre-diversified for you. Most mutual funds will include a mix of stocks, bonds, and other investment products. While there are some mutual funds that are designed to be higher risk, most aim for modest but predictable gains. An annuity is something different from both a bond and a mutual fund, and is another form of quote-unquote safe investing. Do you remember Layla? She's got an annuity. In an annuity, you pay into it with either a single large sum or ongoing payments, and then at a specified date, the company begins paying you. We won't go more in depth into annuities in this lesson, but suffice it to say that they are usually used by people who are preparing for retirement. Back to Flush for a bit. Since he likes a little bit more risk, he has put most of his investment money into stocks. Stock is partial ownership in a company, which entitles you to a share of the profits if the company is sold. Some companies make regular payouts of operating profit to their shareholders. These are called dividends. Not all companies do that, however, and in that case, you can either make money when you are able to sell your stock for more than you paid for it, or when the business sells. Flush has also been looking at the possibility of investing into some real estate. He's considering a rental property with 4 apartments. He can't afford it yet, but he's saving up to make it happen. Real estate is one of the most popular investments people choose to make. Buying land or property has almost always been a safe investment with a predictable return because there's only so much of it and everyone needs a place to live. If you're paying rent, then each time you do, you're paying part of the return on someone else's investment. Most people's first step into investing into real estate is simply buying a home for themselves to live in. You replace your rent payment with a home loan payment, and if you continue to pay it down year after year, eventually you'll have it all paid off. You can also buy a rental property like an apartment building or office building and collect monthly rent payments from your tenants while you're still paying off the loan for the property. This can be a great retirement strategy. The last two types of investments we'll talk about in this lesson are generally the riskiest. These are commodities and cryptocurrencies. Commodities are things like gold and silver, but they can also be things like wheat and oil. The main definition of a commodity is that it's a basic good that is interchangeable with other goods of the same type. For example, a bar of gold mined by one company is essentially the same as a bar of gold mined by any other company, as long as they're held to the same standard of purity. Gold may be a confusing example because while it can be volatile in the short term, it has trended upward fairly consistently over time. That said, it is still an example of volatility, and the vast majority of commodities are more volatile than real estate, bonds, and most stocks. Cryptocurrency is digital currency that is decentralized from the control of government or banks. Cryptocurrencies have created large returns for early investors, but have also experienced a lot of growing pains, resulting in many investors losing money. There's a wide variety of risk within each investment type as well. Some stocks are very safe, while some are very risky. The same could be said of bonds and real estate deals and commodities. So then, what makes a good investment? Well, for Flush, a good investment is something that can make him some money now so he can turn around and use that profit to make another investment. For that reason, he's going to be attracted to options that have the potential for higher short-term returns. That opens him up to more risk, of course, so the burden is on him to perform his due diligence on any opportunity he pursues. Due diligence is the first step to making good investment decisions. Checking a company's financial reports before buying their stock, looking into the title and background of a real estate property before purchasing it, and checking a corporation's bond rating before buying a bond are all examples of good due diligence. So what makes a good investment for you? Well, it depends on how old you are, when you plan to retire, and how you are planning to increase your wealth. As a general rule, a good investment is one that leaves you with more money than you started with. Watch out for promises of returns that seem too good to be true, and make sure you never put up money on a risky investment that you can't afford to lose. Keep building up your knowledge of current market conditions so good opportunities will be easier to recognize. Alright, let's do a recap of everything we've gone over in this lesson. Investing means buying an asset with the expectation that it will increase in value and provide a positive return. The most common investments are savings accounts, real estate, stocks, bonds, mutual funds, annuities, commodities, and cryptocurrencies. Investing is an important part of reaching your financial goals, whether it's just saving money or taking risks to earn a larger profit. A good investment is one that earns you a profit. Due diligence is the most important part of any investment strategy. Bad investments usually happen because of incomplete due diligence, but can also be due to unpredictable market conditions or global events. Do your homework to understand all the pros and cons of your investment opportunities. Remember, there are no sure things. All right, we will see you in the next lesson.